What if the most advanced banking revolution of the 21st century didn't start in New York, didn't come from London, and wasn't invented in Silicon Valley? What if it emerged instead from places the global financial system once dismissed as unbanked, underdeveloped, or left behind? Here is the mystery. Africa skipped traditional banking, yet leapfrogged into the future of money. Before many Western countries mastered contactless payments, millions of Africans were already sending money instantly, without bank accounts, without credit cards, and without internet connections. No marble bank halls. No paper checks. No legacy systems. Just a phone, a SIM card, and trust. Today, mobile banking in Africa moves hundreds of billions of dollars annually, supports entire national economies, and quietly rewrites the rules of finance. But this story isn't about technology alone. It's about necessity, about exclusion, about power, and about what happens when people build financial systems outside the walls that once shut them out. Because what Africa created wasn't just an alternative to banks. It was a challenge to how banking itself works. You've probably heard the headline version. M-pesa changed Africa. But that explanation is too simple, too clean, and dangerously incomplete. Why did mobile banking succeed in Africa when similar ideas failed elsewhere? Why did telecom companies, not banks, become the most powerful financial institutions on the continent? Why do governments now depend on mobile money rails they don't fully control? And why are global tech giants quietly studying African systems, instead of exporting their own? To answer these questions, we must go back, before apps, before smartphones, before fintech buzzwords, to a time when most Africans were locked out of the global financial system entirely. At the turn of the 21st century, Africa faced a paradox. The continent had rapid population growth, expanding urban centers, increasing cross-border trade, but it lacked one critical pillar: access to formal banking. In many African countries, less than 20% of adults had bank accounts. Banks were concentrated in cities. Minimum balance requirements excluded the poor. Paperwork and identification barriers were high. For millions, banking wasn't inconvenient. It was impossible. The informal economy reality. People still saved, borrowed, and transferred money, but informally. Cash hidden under mattresses. Rotating savings groups. Couriers carrying cash across borders. Bus drivers acting as money transfer agents. The system worked until it didn't. Cash was easily stolen, hard to track, dangerous to transport. Economic growth was being suffocated not by lack of ambition, but by lack of infrastructure. A critical overlooked factor: mobile phones. While banks struggled to expand, something else was spreading rapidly: mobile phones. By the early 2000s, mobile penetration was growing faster in Africa than anywhere else. Telecom towers reached places banks never would. Prepaid SIM cards removed credit barriers. People didn't have bank accounts, but they had phones. This imbalance created an opening no one fully understood yet: the birth of M-pesa. In 2007 in Kenya, a simple experiment began. Safaricom, a telecom company, launched M-pesa, short for mobile money. The idea was modest: allow users to store value on their phone and send it via SMS. No one predicted what would happen next. Within months, people used M-pesa to pay rent, send money to families, pay school fees, conduct business. Within years, Kenya became one of the most financially connected societies in the world. Why it worked: cause and effect. Cause: banks ignored low-income customers. Effect: telecoms stepped in. Cause: people trusted phone companies more than banks. Effect: adoption spread organically. Cause: Agents were everywhere: kiosks, shops, markets. Effect: cash to digital conversion became easy. This wasn't technology adoption. It was behavioral alignment. Mobile money fit how people already lived. Replication across the continent. Soon, Tanzania, Ghana, Uganda, Rwanda, Nigeria, Ivory Coast, each adapted the model differently. Some succeeded spectacularly, others struggled. But one thing was clear: mobile money wasn't a Kenyan anomaly. It was an African solution. Traditional banks feel the threat. As mobile money volumes exploded, banks grew uneasy. Telecoms were now holding customer balances, processing payments, offering credit, without being regulated as banks. Banks warned: systemic risk, money laundering, lack of oversight. But the deeper fear was simpler. They were being bypassed. Government dilemma. Governments faced a paradox. Mobile money improved financial inclusion. It increased tax visibility. It supported economic growth. But it reduced state control. It shifted power to private telecoms. Regulators struggled to respond. Too strict, innovation dies. Too loose, loss of control. The first cracks appear. Problems emerged: fraud and SIM swaps, agent liquidity shortages, platform outages, monopoly concerns. Mobile money had grown too fast, and now it faced its first real stress test. From transfers to ecosystems. To survive, mobile banking had to evolve. It did. Mobile money platforms expanded into microloans, savings products, insurance, merchant payments, international remittances. The phone became a financial identity. The rise of fintech hybrids. Startups emerged: Flutterwave, Paystack, Chipper. Wait, they didn't replace mobile money. They built on top of it. Banks adapted or partnered. Some survived, some didn't. Economic impact. Studies showed mobile money lifted households out of poverty, increased resilience during shocks, improved women's financial autonomy. Africa didn't just digitize money. It reshaped livelihoods. Not every attempt succeeded. Copy-paste failures. Countries that tried to import models without local trust failed. Overregulation. Heavy compliance crushed early-stage innovation. Underinvestment in infrastructure. Poor networks limited scale. The lesson: mobile banking succeeds when trust precedes regulation. Access beats elegance. Simplicity wins. Consider this. Over 70% of adults in some African countries use mobile money. Mobile money transactions exceed $800 billion annually. In some economies, mobile money flows rival GDP. Meanwhile, Western countries struggle with fragmented payment systems. Banks move slowly. Legacy infrastructure resists change. The irony is profound. Africa, once excluded from global finance, now leads its evolution. History shows a pattern. When institutions fail to serve people, people build alternatives. Just like informal markets, hawala systems, early merchant banking. Mobile banking in Africa follows the same logic. Innovation doesn't come from comfort. It comes from necessity. As mobile banking grows, a new question emerges. Who controls the rails of money? Telecoms? Governments? Global tech firms? The future of African finance will be decided not by apps, but by governance. And that battle is just beginning. 3 takeaways. 1. Africa didn't copy banking, it reinvented it. 2. Financial inclusion works best when systems match real life. 3. Power follows payment infrastructure. Mobile banking solved yesterday's problem. Tomorrow's challenge is ensuring security, competition, sovereignty, without breaking what already works. If you want deeper insights into financial innovation, African economic systems, global money shifts, subscribe to the channel. Because the future of banking may not come from where you expect. It may already be in your pocket.